Hello there, hello everybody, and welcome to World of Open Account. Welcome to the Supply Chain Finance Learning Lab, where we have today a recording of a webinar that took place. We had some issues with that, so our speakers have been very kind and have accepted to do again for the second time. And second time things will even do better, I'm sure, than the first time. So I'm going to hand over to Stephen, who is the chair, who is the facilitator of the Learning Lab, and who will be also moderating this panel. Over to you, Stephen.
Thank you, Eric. Hi, everyone. Thanks for joining us. Thanks as well for our speakers. And before we start, I think it's best if they can introduce themselves so that we know who we have in this webinar. Tony, if we can start with you.
Sure, very nice to be a participant in this. I've been involved in international trade for longer than I care to remember, from my beginning in credit insurance and then working in a bank and running a trade finance group, a trading company where I was an importer and exporter. I've had some involvement in reverse factoring, factoring, and consulting and supply chain and logistics. So I feel that I'm able to bring the end-to-end experience to the benefit, hopefully for the benefit of the discussion. Thank you.
John?
Yeah, hello there. I'm John Bouger, Managing Director and co-founder of Trade Advisory Network. I've been involved in trade and supply chain finance since a long time ago, when distributed ledger technology was passing a heavy leather-bound file between people across a large desk.
Thank you. Igor?
Hello, yeah, Igor Zaks, also been a while in this industry, been on both corporate side, banking side, one of the first supply chain finance platforms a long time ago. I've been advising many companies and financial institutions for the last 10 years, and now working on some of the newest technologies to be applied there, including some of the AI and blockchain projects.
Great, thank you. My name is Stephen. I'm the CEO and founder of Capital Chains, and I run a consultancy firm focused on supply chain finance for both the adopters, so the users, corporates, as well as the providers, technology providers, fintechs, banks, and non-bank financial institutions. So thank you all for being here. Before we get this started, I think it's great if we can align a bit on the terminology that we'll be using. So what are we speaking about when we say supply chain finance?
Who's that addressed to?
To you by now.
Okay. Okay. Well, we all have our different definitions, don't we? So the narrow definition, which was where the term supply chain finance was initially used, really relates to payables finance or approved payables finance, often known as reverse factoring, confirming also in the Spanish markets, supplier finance, and so on. I prefer a much broader definition, which is the ICC definition, which involves all financing solutions which are triggered by events in the supply chain, whether they be buyer-centric or seller-centric, whether they be receivables related or loan related or inventory related. So it's a much broader definition. By and large, it's open account stuff rather than documentary stuff, because that's really classical trade finance. But if you take a really broad view of supply chain finance, you would actually include trade finance in that as well, because you're still financing the supply chain or transaction paper intensive or data intensive way.
Thank you. And when we specifically focus on today's webinar, what is it that we will be speaking about when we say supply chain finance?
It's the early payment to a supplier of an invoice that's been approved by a buyer for payment at an extended future date. In this way, to give the buyer longer time to pay and improves their liquidity and working capital, and also for the supplier to accelerate cash payment, usually on a without recourse basis, meaning that the supplier will be paid without risk of buyer bankruptcy. And the funding is available from different sources, banks, non-banks, institutional investors, hedge funds, private investment funds, and can be made available either over a platform, a proprietary platform developed by a financial institution, or an IT platform. And indeed, there is the opportunity for a buyer to use available excess cash to invest in early payment to suppliers in return for a discount, thus improving the cost of goods. I think, if I'm not mistaken, that's what we're going to be discussing.
Yes, so I would agree. Igor, if you were already mentioning that you're involved in some of the new techie things. So if I ask you, in this specific space of, let's call it approved payables finance, what are some of the major trends that you see in this space at the moment?
I mean, to start with, when we are saying about supply chain finance, to me, this is predominantly a technology question, because there are no new products. So reverse factoring, for example, or confirming was used for many, many years, even centuries before now, and so did most of the other things we are talking about. So when we're talking about supply chain finance, we are really talking about technology-enabled products, because that's the main thing that's different. You know, so somebody put in a paper stamp and giving you back, and this invoice is approved, please pay us. That's a product that existed 100 years ago. We are saying about some platforms that is doing it. That's what we today refer as supply chain finance. Now, in specific approved payable finance, to me, there are a few generations of the system that changed. So the first one, the prehistoric one, was basically all paper-based. Then there were platforms that were basically doing an upload of approved payables from the ledger, and then, you know, matching them in some way with invoice. Then we get to e-invoicing based platforms. So basically, because the original document was electronic, the matching can be to a certain extent automated. And now we are going to new technologies, and the two main new technologies are blockchain, and there are obviously a lot of blockchain-based projects that are working there. And another part of technology being used is different, more advancing technologies of reconciliation, optical recognition, when effectively people who didn't go to a good technology in the first place, so they didn't go to e-invoicing, there's still some paperwork and things like it. With a cutting-edge technology, it can be transferred to something readable and can be matched with something else. But to me, this is basically just a technology compensation for extraordinary bad processes that is underlying it.
Don, you agree?
Yeah, to a degree, I do. I think I'd go probably slightly further in that it is all about technology-enabled finance, but what the technology should actually enable is the availability of higher levels of finance than would be the case with paper-based solutions. In other words, the technology should not be seen as a means of simply making a process more efficient and perhaps less costly, but actually it should be seen as a means to increase the availability, perhaps to segments of the economy, emerging markets perhaps, where the availability has not been great. SMEs have always struggled to obtain finance, for example. And in that sense, we could ask the question, over the last 15 years or so, since the term supply chain finance has been widely used, and payables finance is a very common alternative label, is what's changed in that time. There have been a few things that's changed, but let's just focus for a second on things that haven't changed. It's the bank finance or the bank run programs are still predominantly focused on investment grade corporates as the buyer. That hasn't changed. The suppliers that are participating in these programs tend to be smaller companies, and those that are targeted for onboarding tend to be the top tier of suppliers that account for the bulk of the buyers, the customers' purchases, which means there has always been a long tail of suppliers that don't get the benefits of the bank-led supply chain finance programs. That hasn't changed. Another thing that hasn't changed is that the supply chain finance provision applies to the tier 1 suppliers of the major corporate buyers. The benefit of these programs has not yet been noticeably extended to tier 2 suppliers and tier 3 suppliers, by which I mean I'm not talking about size when I talk about tiers here. I mean the level, their position in the supply chain.
The supplier of the supplier is typically still excluded.
Still excluded. Now, what has changed in recent years is the emergence of fintechs and other non-bank finance providers that have more of an appetite for the sub-investment grade buyers. Partly out of necessity, they would find it very difficult to access the investment grade suppliers because the banks have got those relationships pretty well stitched up. So they tend to come down market, and they come down market as far as the SMEs in some cases, where there's a heavy reliance on credit insurance. So it's a different proposition. It works the same way. The supplier gets paid shortly after shipment instead of having to wait 60 or 90 days. But the drivers are different. You know, the SME and mid-cap buyers are not really interested in accounting treatment. They just want the cash. They would just want deferred payment terms so they can have the cash. And the need for credit insurance adds an additional cost to the programs. And indeed, the fintech's cost of funds is usually higher than the banks. So these tend to be quite expensive programs, and they are much smaller in scale. But the fintechs do generally have better technology, so they can make the onboarding process and management process much more efficient. So there's a bit of a balancing out there of some of the benefits. So those have been some of the trends. I mean, you mentioned, or I think Tony mentioned the emergence of what we refer to as dynamic discounting, where buyers who from time to time have a high level of spare liquidity, they actually invest in their own programs, often through a special purpose vehicle. So you see, so even the bank-led programs don't necessarily get funded wholly by the banks. Sometimes they might get funded by other parties, and hence the emergence of third-party platforms that can bring all these funders together. The banks, the non-banks, the asset managers, the family offices, and indeed the buyers themselves.
Yeah, so
yeah, I think.
Sorry.
Just I want to add one quick thing. One of the trends I think that's been made evident in some work done by the World Bank is the observation that banks are withdrawing from cross-border trade to the extent that the regulatory environment has not proved conducive to take on assets at a very low pricing, and so quite a lot of the bank programs have become originate to distribute vehicles, and along with the withdrawal of the banks from correspondent banking and closing offices in developing countries, etc., you've ended up with a $1.6 trillion trade finance gap for SMEs in developing countries, and that talks specifically to the growing need of smaller suppliers in these countries to be able to avail themselves of relatively inexpensive early funding for invoices that have been approved by larger foreign buyers. And that spawned the entrance into the market of some supranational organizations like the World Bank and the IFC, part of it, which have a program now to bring national banks onto these platforms in developing countries in the hopes that this will bring financing to smaller exporters in that part of the world. So that's another, I think, interesting trend that's going on. And the other aspect of this is that there's an increasing take-up through the development of e-invoicing in the world and procure-to-pay platforms, that those platforms themselves, like Ariba and even Amazon, are offering early payment. I got an offer the other day from American Express as a small business, offering me 30, 90 days to pay and paying my suppliers early at a relatively cheap rate. That's a relatively new phenomenon to me. And the increasing focus on domestic supply chain finance, I know that we're going to be looking at cross-border early payment of approved invoices, but domestically, that's become a very strong interest.
Yeah, so can I summarize very quickly in between, Igor? Because we've touched upon a couple of points that I think we'll have to take up as we go along. So there's the banks and the fintechs, the difference, and bank versus fintech or bank with fintech. There is, let's say, the differentiation between countries, so the developed and the developing countries, and let's say the banks versus the non-bank financial institutions, which will probably play a major role, especially in the developing countries. Having come back from South Africa this morning, I know that the trouble that they run into locally is they would like to do more, but the supranational institutions coming in don't have the local currency to fund, which then becomes the issue of, we'd like to do this, who's got the funds? It's the local banks who then need to develop their capabilities, specifically in this regard, to really grow the business. Igor, if I can pose a question to you immediately afterwards. If we're looking at banks versus non-bank financial institutions in supply chain finance, do you see any advantages or disadvantages of one or the other? And are there different regulations for these institutions?
Oh, absolutely. So you get basically three segments that are interesting from point of view of finances. So you have the banks, you have non-bank financial institutions such as insurers, and you get people who are in unregulated space such as funds. So if you look for banks, there is one massive advantage. The massive advantage is cost of funds. Banks can attract deposits, they have deposit insurance, they can attract money for close to nothing. Disadvantage of this is prudential regulation coming with it. And the specific disadvantage that is going towards our assets is that the bank regulation is not geared to trade receivables. They're not even geared to a short-term assets. They're calibrated, the risk models used by banks for capital allocation are calibrated on loans. And the risks are different. So, and that's making for banks quite difficult to be able to fund things outside of, say, major corporate space and things like it. And that's exactly where the limitation is coming. But where the banks can fit, the cost advantage is massive. We get the second segment, and these are the non-bank financial institutions such as insurers. They're also regulated. They have Solvency II, and they have other sort of regulations there. But the difference is the models they're using are calibrated on actual losses. And the loss on trade receivables historically have been quite low. So in this case, the cost of taking risk for them is smaller. Again, what they cannot do, they cannot fund themselves in most of the cases. And there are in various jurisdictions different issues of to which extent banks can use, for example, credit insurance policy as risk mitigation for their regulatory purposes. And then you get a non-bank financial institution, non-regulated institution. So you have various funds, whatever. They obviously have no regulatory restrictions in terms of how they can do it. However, the cost of funds is significantly higher. And that's where a big gap is coming in terms of the programs that are funded basically within a low-cost banking environment or within people who require a fairly high return. We are saying significant or higher numbers. In many cases, people build leverage in it because they really need to achieve a return for their investments.
Yeah. Tony or John, you have anything to add on why they're different or better positioned?
Well, I think Igor's covered it pretty thoroughly. I think there's an appetite question mark over the banks as well, in that these are large corporate relationships. And every bank will have a single name concentration limit. They'll have an appetite for the bank. And whilst these payables finance facilities are technically balance sheet neutral from the customer's point of view, they do absorb debt capacity. They do use up part of the bank's appetite for that name. So the bank has a lot of products that they want to sell to these corporates, and they don't want large sums tied up in programs which have a long rolling period. They continue to roll over month after month after month and year after year. So they tend to put a cap on the level that they're prepared to support a large corporate, even one that's got a great credit rating, and they're very happy to support, because they want to keep some capacity back for the big event-driven financing opportunities, which might be M&A related, where they have the potential to generate very large fees in a very short timescale, and have the asset on their balance sheet for a small amount of time, and then they get rid of most of the asset, but they need capacity to do that. They need to keep their powder dry, so to speak. So that doesn't negate the bank's advantage, but what it tends to mean is that the banks are perhaps a little more prepared to collaborate in programs than they used to be, because it keeps them in play with the corporate. It maintains the relationship, and it enables them to generate a good, steady return, not spectacular return, but a steady return without using too much of their own capacity. And I think the collaboration between the banks and the fintechs has become useful in this regard. A lot of banks don't like using other banks' platforms. So traditionally what will have happened is that a bank with a strong presence in a particular market will say, we'll look after all your suppliers in the market where we have a strong presence on the ground, but we won't try and onboard suppliers in markets where we don't have a presence, and we'll let another bank do that. And that's fine, because it's playing to their strengths, and it eases the KYC problem, which I know we'll probably talk about a little bit more later. The problem with that is that the customer now has two bank platforms, or possibly more than two bank platforms to worry about, two different administration processes, and their data is then no longer consolidated. It's far from ideal, and basically not acceptable to a global corporate with multiple banking relationships. So the emergence of fintechs, who are not actually interested in funding directly themselves from their own balance sheet, but actually they facilitate the involvement of multiple banks in a multi-bank program, so that it's easy for the buyer to use the services of all the banks. And I think that's a good example of how fintechs and banks have collaborated to create a better proposition for all parties.
Thank you. You're right on point with the banks versus fintechs and KYC, and I want to go on that topic as well. Tony, it used to be back in the days, fintechs would come in and say, we're going to kill the banking industry, right? We're going to take over. This is our era. Our time has come. At the moment, it feels like we see more of a bank with fintechs approach, or fintechs with banks. Also from their side, more looking for a collaboration model. Does that mean that if we see this collaboration, and as John is explaining, they may be better suited to let banks play in the region where they are most efficient, does that mean that we will also be able to reach more of the long tail suppliers?
Well, I think that's inevitably the case, because we said earlier that there's an inherent contradiction between the bank strategy in terms of developing presence in developing markets. They are withdrawing from that. They have no appetite to deal with SMEs in developing markets in many of them. They obviously continue in some. And that then leaves those suppliers to Western buyers shortchanged. The fintechs can certainly assist in that. And there are several examples of how one or two of them have really taken on board the challenge of making it easy to allow suppliers to avail themselves of early funding of approved payables. The challenge, I think, is that that many of these programs require, I mean, John earlier talked about the buyer side, the corporates having to have multiple platforms or multiple programs. I think this is equally a problem for the suppliers, because every buyer might have several bank platforms or IT platforms that they avail themselves of payables financing through. And that means that the suppliers have got to have multiple capabilities to access this funding. I think one of the benefits of the fintechs is that we are going to veer towards a more agnostic, neutral type of platform that will certainly bring on many more of the smaller suppliers, and perhaps even may attract some of the mid-size and smaller buyers.
Okay. And do you think that there's also more appetite in the market to go to smaller buyers, or to go to mid-market?
Oh, yes, for sure. Well, I think there is because there's a higher. I'm sorry, was that question addressed to me?
Yes, now it is, and then we'll go to John.
Sorry, I'm dying to hear what John has to say. I think it certainly is. Sorry, can you just repeat that question, because I lost my train?
Is there more appetite in the market to go to smaller buyers, the mid-market segment?
Yes, I think that's for sure. And the reason being that there is a higher return possibility. The market for the larger corporates has become very thin. And in terms of regulatory capital and compliance with Basel, it's becoming an imperative to distribute those assets to institutional investors and others rather than keep them on balance sheet for the banks. For the mid-size buyers, there is a much greater opportunity to earn a return because the cost to mid-sized non-rated buyers is substantially higher than for rated investment grade buyers.
And I would say there is also a fact that when the risk is concentrated, there is obviously a high risk of some of these buyers. But if you look at a portfolio, what experience has shown, it's very often better to have a number of diversified buyers that will be part of your portfolio that you are financing, than to have one large relatively high risk buyer that we all see in examples of like Carillion or many other companies when people have a large programs for a supplier. There's a large corporate but not very low risk corporate. So in this case, from point of view of investment and from point of view of many people who are buying this type of asset, getting a number of mid-size, mid-risk type of buyers is on a portfolio basis much better proposition that again a mid-risk large suppliers, and that's something driving investment strategy for many of them.
Thanks, John.
Yeah. I mean, I don't see any evidence yet that the big banks are extending their supply chain finance programs down into the mid markets and below. I think the non-banks are, and once you move out of the investment grade category, the price sensitivity goes down, and the return naturally should be higher anyway because the risk is higher. So yeah, the non-banks have an easier role there to play and are able to accommodate that risk more easily. But the return generally is higher. But the big banks, as far as I can tell, are still concentrating mostly on the investment grade corporates. If there is a move towards sub-investment grade and mid-cap, it's certainly not that evident yet. I mean, maybe it will be in the future. And I suppose as technology enables more efficient onboarding, and if the banks have less work to do, then the cost inefficiency of working with smaller buyers becomes more bearable if somebody else is doing the work and they're doing it very efficiently. So I think the trend ought to be in that direction for the larger banks, but I haven't seen any evidence of it yet. I mean, they would have to rely on the KYC being done on their behalf by a technology solution. And whilst you can outsource the KYC processes, you can't outsource accountability. Yeah, a lot of the banks will tend to be relatively conservative and say, well, we still have our standard KYC and it's still got to be done. And until that really changes, I think that the banks will stick mainly in the investment grade buyer space.
I think you're probably right there, John, but there are a couple of examples, at least in the US. Wells Fargo is well known to be looking at mid-size buyers for their program. And I think that might be to do, and there may be an interesting connection here between those banks, large banks that have a factoring or asset-based lending business, particularly factoring, where they would be offering the risk mitigation of buyer bankruptcy when they buy an invoice from a supplier, and to that extent they may well be far more adept at assessing small and mid-sized buyers than perhaps other banks that don't have a factoring business.
Yeah.
And Wells is obviously a leader in that area.
Yeah, you're right. And I think the other attraction to that business, undertaking that business, is that the need to have the accounting treatment sorted out. In other words, not having trade payables reclassified as bank debt. That's a huge issue for investment grade companies. It's not such an issue for sub-investment grade, mid caps and SMEs. So some of the constraints around credit appetite and risk mitigation, taking security, using credit insurance and so on, which would not really work in the investment grade space at all, that can work in the mid cap space, which will then have the effect of increasing the appetite. So I think there are a number of things which could lead to a general move amongst perhaps the non-global banks and the banks with specialist supply chain finance, asset-based lending capabilities to actually move down markets somewhat. But just going back to the original question, are the fintechs eating the bank's lunch? I think the answer is no. There's no evidence that they are. When the fintechs first came on the scene, and I don't just mean the technology service providers that work with banks, these were the ones that set up in order to compete with banks. And their sales pitch was, we're easier to deal with, we're faster, we have more credit appetite, we're friendly, we don't wreck the global economy, etc. And they made a virtue of the fact that they're using technology and algorithms to make the decisions, so the decisions are really fast. In practice, those models have proved to be less scalable than they would have liked, and therefore it's struggled to get critical mass in any of the portfolios. So they're not really saying that anymore now. So I don't think any fintech is saying we can do what the banks do, but better, cheaper, faster, and more friendly. Most of the fintechs are now saying, actually, we complement the banks because we will enter those markets that the banks don't really have an appetite for. So they can still maintain their relationships and will provide additional finance and additional solutions which are complementary to what the banks do. And actually, it's a happy marriage, a sort of marriage of convenience, but it's a happy-ish marriage.
Mm-hmm. Maybe if I will extend a little bit on John's point, we saw a number of disasters in a fintech sort of platform space that were trying to think the problems are easier than they were. Like Eureka, for example, will be an example, but a number of others that were saying, okay, that's great. We will make a simple platform to do everything. We'll buy, say, insurance in Eureka case, and then we'll do a peer-to-peer distribution. And what a lot of these people did not recognize is that, for example, the costs that people have on preventing fraud cannot be just dropped. You really need to make an efficient mechanism to deal with this. And the cost of doing it on a real small size invoices, small size transactions is actually high with whatever technology you're using. And again, cost of peer-to-peer funding was high and things like it. So you're pushed to a very particular subsegment. So what we saw so far is that majority of this sort of peer-to-peer supply chain finance platforms, original premises of Eureka, Platform Black, a whole bunch of other people, none of them scale, and majority of them get into some type of a serious bump along their road.
Yeah, that's absolutely right.
Yeah. So let's say we're past that point where it's bank versus fintech or fintech versus bank. It's a collaboration model. They work together. It's a happy marriage. The next potential stumbling stone comes by, which is the legislation in some countries around payment terms. So in the EU, you see the EU payment directive, which is geared towards 60 days. In some countries, it is 60 days. In other countries, rules are even in place that smaller suppliers should actually be paid ideally within 30 days, which leaves less room for the, let's say, original story around the buyer gets to extend its terms and then the supplier is happy because he gets paid even earlier than he used to before. So can I get your opinion on that, as well as, and I think we can't leave that unmentioned, the growing voice in the market that approved payables finance would be a bad practice because you should pay your suppliers just early in general. Can I get your opinion or thoughts on those two elements around payment terms, so to say?
Well, I kick off with that. I think the requirement in many markets for buyers to pay promptly and not drag out payment terms beyond what is commercially reasonable, I don't think that invalidates the real need for supply chain finance. It probably does undermine the spurious benefit which was used as a sales pitch for supply chain finance when the concept was first introduced, which was it allows a buyer to extend payment terms somewhat beyond what was reasonable, because that the supplier could still get paid promptly. I think that has been discredited in large part. So I don't think we should be seeing now large buyers trying to take advantage of suppliers and then relying on the supply chain finance programs to compensate. That's not ethical, in my view. Whether 60 days is the right number, or 30 days, or 90 days, I don't think that should be legislated as such, because different types of goods have different life cycles and different engineering times and go into different processes. So if you're sourcing materials which go into a complex manufacturing process which involves a lot of inventory, and that's the nature of the business, and there's a strong collaboration between supplier and buyer, then it might be quite reasonable to have extended payment terms, so you're sharing the pain, and then putting in place a program which enables the suppliers to get paid properly is then a good thing. So the benefits of the supply chain finance solution are not just about extended payment terms. So I think they're compatible with any regulatory drivers which force companies to pay promptly. I mean, the benefits should be that you're stabilizing your suppliers, you're enabling them to have access to funding on a basis which is more favorable than would otherwise be the case. Firstly, it should be cheaper because the credit risk is usually better quality because of the arbitrage opportunity. And secondly, the quantum, the amount of finance available is no longer linked to the supplier's debt capacity or the availability of tangible security by the supplier, which is, if you're an SME, tangible security is still the main determinant of how much facilities you're going to get. So for all those reasons, there is a good story behind a payables finance or supply chain finance solution, and it's not just about supporting extended payment terms.
Yeah, thanks. And especially the rating arbitrage will become smaller, the opportunity for it when you go down market. So the mid market will be more indeed around the total amount of funding available, not necessarily the cost of that funding.
Yeah.
So fully agree with that.
Yeah.
And I mean, one thing I will add, regardless of the payment terms, receivables are a major asset on the balance sheets of many companies, including many SMEs. Now, and this asset is used for financing. Now, the real question is supply chain finance versus asset-based lending versus factoring versus other type of financing that people can obtain versus the receivables. And supply chain finance in majority of the cases is the most cost competitive option of like a specialist funding using this type of asset. So in this case, even if we are saying nothing changed with the payment terms, but we are saying that by effectively providing nothing more than information from point of view of the buyer, so basically giving the information about approved payables and providing it to financial institution, the suppliers can significantly reduce cost of funding using specific assets they have. That's a good thing. Now, whether the extension of terms is a good thing, I'm not so sure. And the biggest problem there is not when the model is working smoothly and when the model is not working smoothly. So what we see, for example, in Carillion example, people extend the payment terms and then the supply chain programs were withdrawn. And then you really get a problem because like the terms are non-sustainable, and the moment this facility is not there, all the suppliers are in a very, very deep trouble. If you're saying about something that is like a normal type of relationship and effective with supplier is assisting the buyer assisting their suppliers in better utilizing the assets on their balance sheet, that in my view is a positive thing.
Yeah, I agree.
I think we should all bear in mind as well, we should bear in mind that SMEs in particular, mid-caps as well, when they sell to larger corporates, their costs and their risk starts before they ship the goods. So if they're relying on a program, they're relying on the fact that they should get paid, let's say within 10 days of raising an invoice, assuming it's approved promptly. So the extended payment terms in their minds, don't matter because the bank has said, look, you log on to this platform and you press these buttons and you get paid quickly. So they happily gear up, they happily acquire their stock, run their factories, run their processes, pay the salaries and so on, have a warehouse full of materials that they're now about to ship. And because they're SMEs, they're not knowledgeable about financial matters at all. They're usually engineers or manufacturers or not consumers, I should say, farmers, whatever it is. They're not expert in banking, so they don't appreciate these programs are uncommitted. And if there's some sign of stress on the buyer, as Igor says, the banks, as soon as they spot that sign of stress, will stop funding. Now, you could ask the question, well, how is that different from invoice discounting? It is different because the invoice discounting solution is usually supported by credit insurance, or very often is. So there are two bites at the cherry in terms of getting paid. The invoice discounting solution does not involve artificially extending payment terms. It's normal commercial terms. There is no assumption when you're an SME selling on open accounts and using invoice finance as a solution. There's no assumption, or there shouldn't be an assumption, that there's a ready supply of funding which is constantly available and will never change. They know that their factoring company, their invoice discounter, their appetite for the buyer will go up and down, and they will say the limit's gone up, the limit's gone down, and the availability will be reflected on the platform. So there's a shorter period within which to adjust. They can still get stuck with a load of stock. Yeah. If they manage that, if that's how they manage their supply chain, but it's less acute than would be the case if they become reliant on a source of funds which they think is never going to go away. And I think that was the case with Carillion.
Yeah, and I think Carillion is not necessarily the best example of supply chain finance, because we've had the same situation in the Netherlands, not with let's say a bankruptcy around supply chain finance, but suppliers continuing to deliver to our national Vroom en Dreesman, which was a big fashion retailer as well, whereby everyone knew that they were in trouble, but it was better for them to continue the delivery of their goods, hoping that they would be paid, than to stop the delivery and making sure that they were left with inventory. And I think similar situation is around Carillion. They've extended their terms, but everyone who was working with them should have seen that that was a sign of distress to some degree.
Yeah. Yeah.
And it's also true of Abengoa, where I think you had terms that sometimes went out to 180 days. And as a trade financier, we were taught from the beginning that you should look at the cash-to-cash cycle in the transaction flow. And if a buyer is taking goods and converting those goods to cash in 15 days, what the hell is it doing taking 180-day terms from its suppliers?
Yes.
It's completely out of whack. And there is a responsibility on the part of underwriters in these programs to understand the underlying transaction cycle and to make sure that the terms match the needs in a sensible way.
I agree. If we move on, right, we started our session with what are we currently seeing in the market. We discussed a bit of the landscape, the players in that market, and what are some of the advantages or disadvantages were. If I can ask you to give us a prediction, where are we going to be at the end of 2019 or even beyond that? What's the next big thing for this particular space? Igor, can I start with you?
Yeah, sure. I mean, in my view, if we are looking at the traditional supply chain finance, in terms of the large investment grade buyers and first tier suppliers, whatever, it's very little money being left there. The margins basically collapsed. So effectively, that means that people need to find sources of return, and main sources of return is taking a little bit more risk. A little bit more risk, maybe going down the risk curve from point of view of the buyers. So we are going to see a bit more of a mid-market or lower investment grade or maybe even sub-investment grade buyers, and we will see various type of programs, various type of risk distribution being dealt there, or it can be programs that will involve some degree of performance risk one way or another. So we are going into this extended definition of supply chain finance like ICC, and we are saying, yeah, we started with just doing a traditional buyer-centric approved payables, but now we want to go a bit more into inventory, a bit more into PO, a bit more into something, and basically go beyond the cycle. So I think what we will see people going beyond it. That means there will be technology aspects of these platforms to better capture this type of things, artificial intelligence tools to better understand, better measure this risk, and there will be some sort of cooperation and distribution, because some of the, for example, banks are very well geared to some type of risk and not geared at all for some other. So I think we will see more collaboration and more use of technology to be able to capture this sort of wider universe.
Mm-hmm.
Thank you. John?
Yeah, again, I think I would agree with that. The proposition has got to be broadened for a couple of reasons. One is it'll generate more income, but there is a higher degree of risk. So the risk-reward equation needs to be adjusted. But I think what I'd like to see, I'm not sure we'll see it as early as next year, but what I'd like to see, if we think about moving into the mid-cap space and the SME space, is that we shouldn't be quite so fixated about one product, one technique acting in isolation as a program. I would rather we use the technology to support a financing solution which starts with the PO, covers the inventory and the goods in transit, the invoice, the approval of the invoice, and then eventually the payable at the payment of the invoice at maturity, and using the technology to create an availability underpinned by movements through the supply chain from one end to the other, rather than simply saying, here's a pile of payables, let's run a program, or here's a pile of receivables, let's decide what our appetite is, take away the dilutions and the ineligible invoices, and we end up with a much smaller limit to work with, but we've still got security interest in a very large pile of receivables. That's sort of very product led. It's very binary, and I think the technology exists now, whether it's distributed ledger technology or artificial intelligence on the control side of the equation, to say, well, we should be able to look across the supply chain and provide an overall availability to the client to support their trade cycle from purchase order through to payable.
Yeah, and that actually speaks to the convergence that is going on between the various functions of finance, logistics, trade, and data. That convergence is actually a prerequisite to making the above work. And to the extent that that's going on, which it is, that transparency and visibility and the ability to take data and analyze it so that risk management can be optimized and the application of funding can be made available, and even financial institutions taking ownership of inventory as a way of providing financing for it. Because, at the present time with accounts payable finance, you have inventory on the balance sheet of the buyer, and now we're just talking about how do we fund the purchase of that inventory. Payables financing seeks to extend the terms out so that suppliers have to give longer terms to buyers to fund that inventory that's on the buyer's balance sheet. But one other option, of course, would be to take the inventory off the balance sheet of the buyer early and have a funder that's comfortable in logistics, comfortable in finance, understands the underlying trade, and is using data to apply the financial solutions in a more informed and intelligent way.
Yeah, and I think if you think about it, that's completely logical, because what we have at the moment is the smaller party of the two parties we're focusing on, the seller and the buyer. The smaller party, the seller, is having to carry the burden financing the inventory for the buyer. And then the buyer is trying to help facilitate that by arranging a program with their bank. Now, if the buyer is a global corporate, that's doable. But if the buyer is not an investment grade global corporate, it's very, very difficult. So why adopt that approach to solving the problem? Why not actually have reasonable payment terms for the supplier and then have another solution for the inventory, which takes the inventory off the balance sheet of the buyer? So it's a different set of skills. It's not necessarily something a traditional bank in their main banking arm would possibly want to do, because valuing the inventory is never going to be easy unless it's a commodity that's traded and you can put a price on it. But if it's components that go into a manufacturing process which turn into a hovercraft in 3 months' time, how do you value the little components? Terribly difficult from a bank point of view, because what do you put on the balance sheet as an asset? So, but a non-bank or a non-bank division, subsidiary, or a special purpose vehicle, those are better potential options for taking the inventory off the balance sheet.
Yeah, and that potentially means you get a supply chain finance house, which would take ownership early on in the supply chain, and which means that you only need to finance the value add for the individual nodes in the supply chain as it passes through that supply chain.
Yeah. And I mean, again, if we look there, we have two things that are changing. One, we have much more data than we historically have. So a lot of the approaches are still based on assumption we have virtually no data now. Today, if we look to a lot of the systems, we have tons of data. And the second thing is we also get significantly better models that can deal with a much more complex interrelationship than before. So we don't really need to, show a normal distribution and see whether it's like 3 sigmas out of the mean. We have a whole range of tools and a whole range of data, and that's allowed to make far more intelligent decisions.
Mm-hmm. Great. I think we're going to leave it at that. That's a nice prediction for the future. I want to point out for everyone who's watching this video, if it's before the 23rd of April 2019, we'll have our next session on accounting and the rating implications of supply chain finance programs on the 23rd of April at 4 o'clock Central European Time. If you're looking at this video afterwards, then we hope that you will click through, because the other video will also be available on World of Open Account. For the time being, from my position, I'd like to thank Tony, John, and Igor for sharing their thoughts, and Eric at WOA for making this all possible. So thank you.
Thank you very much, Stephen. Thank you very much, Tony and John and Igor. And let's do another session on the 23rd in any case. Thank you very much. Talk to you soon. Bye-bye.
Okay. Thanks. Bye-bye.
Thank you.
Bye-bye.